When 50% of all VC goes to one sector, markets may well break. Welcome to Nothing Ventured. I'm Aarish, and October brought us a number that should terrify anyone who cares about innovation diversity. AI startups pulled in $192.7 billion so far in 2025, putting us on track for the first year where more than half of total VC dollars go to a single industry. The maths that doesn't work. Let me put that in perspective. Global VC reached $120.7 billion in Q3 alone, according to KPMG. That's 4 consecutive quarters of $100 billion plus investment. But here's the reality. Anthropic raised $13 billion and XAI raised $10 billion in Q3. Just 2 companies accounted for nearly 20% of the entire quarter's global venture funding. It's hard to suggest that this is diversification or even risk management. It feels like a concentrated bet on foundation models by investors who are terrified of missing out. Well, what happens to everything else? While AI companies are swimming in capital, the KPMG report shows Asia saw only $16.8 billion in Q3, the lowest in years. China managed just a paltry $5.1 billion. These used to be vibrant innovation ecosystems. Where did that capital go? Into the same American AI companies that already have billions in the bank. The circular financing problem returns. Remember my segment last month about Nvidia financing its own customers? That problem is metastasizing. Anthropic's $13 billion round will largely be spent on compute infrastructure, buying Nvidia chips, renting from cloud providers who buy Nvidia chips, and hiring engineers who optimize Nvidia chips. Once again, this is vendor financing disguised as venture capital. And when the music stops, the write-downs could be spectacular. Why the UK's $9 billion quarter matters more than AI's billions. Now, let's talk about a market that seems like it's actually working, the UK. Because whilst everyone is obsessing over billion-dollar AI rounds, the UK just delivered its second highest Q3 on record with $9 billion in venture funding. And the composition of that funding tells a completely different story than what's happening in Silicon Valley. The numbers that matter. UK startups have raised $17.3 billion year to date, matching all of 2024's funding in just 9 months. If we were to project out to the end of the year, that could mean closing at a whopping $23 billion for 2025, making it the best year since 2022. But here's what makes this interesting. There were 46 Series A rounds in Q3. That's the highest in 7 quarters. This tells a story beyond late-stage capital concentration. It is more akin to actual early-stage ecosystem health. Let's talk about the Revolut effect. Yes, Revolut raised $2 billion and Nscale raised $1.1 billion. The first time since 2022, the UK has seen multiple billion-dollar rounds in a single year. But even excluding Revolut, the UK raised $7 billion in Q3. Compare that to the entire Asian region at $16.8 billion. The UK, with 67 million people, raised 42% of what all of Asia raised. The regional distribution story. Here's the part that should make Silicon Valley VCs uncomfortable, or at least interested. 45% of UK funding rounds in 2025 happened outside of London. Cambridge raised $2 billion, Oxford raised $406 million, and these aren't being seen as satellite offices of London companies. These are independent ecosystems built around world-class universities producing deep tech companies. In addition, we saw Quantinuum raise $600 million for quantum computing, and Cusp AI raised $100 million for AI materials discovery. These are infrastructure plays, not AI wrappers. The sector diversity advantage. Fintech led with $5.3 billion, driven by Revolut, but also including Zelix at $160 million and substantial payments infrastructure investment. Healthcare came second with $3.2 billion across AI drug discovery, isomorphic labs, gene therapies, clinical trial platforms, and surgical robots. Quantum computing hit $688 million year to date, record levels from a very low base, with companies like Quantinuum, Oxford Quantum Circuits, and Riverlane all raising significant rounds. This is what a healthy venture ecosystem looks like. Multiple sectors, multiple stages, multiple geographies. Not 50% of all capital going to foundation models. Series A is back, but only for real companies. So let's dive deeper into what the UK data reveals about Series A, because this is the most important signal about venture health that nobody is discussing. The 7-quarter high, 46 Series A rounds in Q3 sounds modest until you realize this is the highest number in 7 quarters. During 2023 and early 2024, UK Series A activity was in the 20s and 30s per quarter. This isn't just about more rounds, it's about what kinds of companies are raising Series A that's really revealing. The £100 million Series A barrier. Cusp AI raised $100 million Series A for AI-powered materials discovery for sustainability and clean energy. Think about this as infrastructure-level AI applied to physical material science. Alchemab Therapeutics raised $32 million for adaptive immunity drug development. T Therapeutics raised £24.2 million for oncology therapeutics. These aren't software companies that can scale on AWS credits. These are capital-intensive, scientifically rigorous companies that require years of R&D before commercialization. What this signals about market maturity? Well, when Series A activity increases for deep tech and biotech, it means 2 things. 1, investors have done their work. You can't hand-wave your way through a Series A pitch for quantum computing or gene therapy. Investors need to understand the science, the regulatory pathway, and the commercialization strategy. And 2, exit markets are functional. Nobody funds £25 million Series A's in gene therapy unless they believe pharma companies will acquire the winners at meaningful valuations. Let's put this in the global context. Remember, global early-stage investment fell to $24 billion in Q1, the lowest in 5 quarters according to Crunchbase. Seed funding dropped 14% year-on-year, but UK Series A is at a 7-quarter high. This divergence is telling us something crucial. Capital is finding quality at the early stages in markets with deep technical talent and reasonable valuations. The unit economics reality. Here's what founders aren't being told. In the US, Series A medians are at $48 million with sky-high valuations. In the UK, they're in the 20 to 30 million range, or $25 to $38 million, with more reasonable terms. Which companies do you think have better chances of hitting their milestones and raising Series B successfully? The ones that need to 10x to justify their A, or the ones that only need to 3x? $150 billion in exits might actually save venture. Now let's talk about the development that could actually fix venture capital's liquidity crisis. Global exit value climbed to $149.9 billion in Q3, driven by IPO activity. Why this matters more than funding? Well, venture capital has been drowning in a liquidity crisis since 2022. Just listen to my podcast with Leila Kunamoto if you want the LP perspective on that. Funds raised money in 2018 to 2021, deployed it in 2020 to 2022 at peak valuations, and then, well, nothing. No exits, no returns, no distributions to LPs. Without distributions, LPs don't commit to new funds. Without new funds, VCs can't make new investments, and the whole ecosystem seized up. $150 billion in exits in a single quarter is the pressure valve opening. The M&A engine restart. Startup M&A exceeded $100 billion in half 125. That's a 155% increase year on year, according to Crunchbase. And these weren't fire sales. Google's planned $32 billion Wiz acquisition could be the largest startup acquisition ever. OpenAI spent $6.5 billion buying Johnny Ive's IO. ServiceNow paid $2.85 billion for MoveWorks. These are strategic prices, not distressed prices. The IPO window cracking open. Circle and Chime both went public in 2025. These aren't spectacular growth stories. They're mature fintech companies with real revenue and defined paths to profitability. That's exactly what the market needs. Not every IPO has to be a rocket ship. We need exits for good, boring companies that make money. A trend that more and more VCs I speak to are backing. What this means for venture returns. Well, here's the maths that matters. If you're a VC fund from 2018 to 2020, you're approaching year 5 or year 7. You need to show distributions to have a chance of raising your next fund. $150 billion in quarterly exits means some funds are finally returning capital to LPs. Those LPs can then commit to new funds. New funds can invest in the 24 to 26 vintage of companies that raised at reasonable valuations. This is how venture cycles work. The 21 to 23 freeze is thawing. Well, what are the UK implications? The UK produced 241 thoroughbreds. Well, that's companies generating $100 million plus in annual revenue, alongside 198 unicorns. 120 companies are both unicorns and thoroughbreds. These are acquisition targets. When you have real revenue and billion-dollar valuations, you're exactly what strategic acquirers want. Is this the end of American venture exceptionalism? Let's close with a bigger picture. The Americas accounted for 70% of global VC funding in half 125, according to Crunchbase. That sounds like dominance, but it might actually be a warning sign of unhealthy concentration. The numbers tell a fragile story. In the Americas, $85.1 billion in Q3. In Europe, $18.8 billion. That's based on the UK's $9 billion, representing roughly half. And Asia, $16.8 billion. But break down that $85 billion in the US, and you find it's driven almost entirely by AI foundation model rounds. Without Anthropic's $13 billion and XAI's $10 billion, funding in the US would be down quarter over quarter. The European strength in diversity. Whilst Germany surpassed the UK in Q2, as we discussed last month, the UK's Q3 rebound shows something important. Europe can sustain $25 to $30 billion in quarterly VC investment across diverse sectors. Mistral in France raised $1.5 billion, Nscale in the UK raised $1.5 billion, but Europe also saw hundreds of $10 to $50 million rounds across fintech, healthcare, quantum, and climate tech. Compare that to the US, where if you're not raising for AI, you're struggling to even get a meeting. The Asia paradox. $16.8 billion in Q3 for all of Asia is shockingly low. China at $5.1 billion is particularly concerning. That's what they used to raise in a month during the boom years. But look at the quality of deals. Firmus in Australia raised 330 million Aussie dollars, that's 220 million US. Minimax AI in China raised $300 million, and Rebellions in South Korea raised $244 million. These aren't consumer apps or e-commerce plays. These are AI infrastructure and hardware companies solving very different problems than OpenAI. The prediction? Within 18 months, we may well see a normalization where the Americas drops to 55 to 60% of global VC as AI mega rounds normalize. Europe may well stabilize at 20 to 25% with continued strength in deep tech. And Asia could well recover to 20 to 25% as China's innovation economy adapts and India continues to grow. The story, therefore, isn't really about American decline necessarily, it's global rebalancing towards healthier diversification. The UK position, well, the UK raised $17.3 billion in 9 months, on track for $23 billion annual. That's roughly what the entire UK raised in peak years like 21 or 22, but with fundamentally healthier composition. 45% outside London, multiple billion-dollar companies, Revolut, Nscale, record Series A activity, leading European quantum ecosystem, dominant fintech sector. This isn't a flash in the pan. This is what happens when you have world-class universities like Cambridge, Oxford, Imperial, and UCL, deep technical talent at 40 to 50% lower cost than San Francisco, strong IP protection and rule of law, access to European and US markets, and government support for R&D and innovation. So what does October 2025 tell us about where venture is heading? 5 key takeaways. 1. AI concentration is unsustainable. When 50% of capital goes to one sector, you're not building a diversified ecosystem, you are building a bubble. 2, the UK model is working. Diversified sectors, strong regional distribution, record Series A activity. This is what healthy venture looks like. 3, Series A is back for quality. Deep tech and biotech raising meaningful Series A's signals investor confidence in long-term value creation. 4, exits are returning. $150 billion in Q3 exits means the liquidity crisis is easing. LPs can finally see distributions. And 5, geographic rebalancing is inevitable. America's dominance at 70% is temporary. Expect normalization towards 55 to 60% as other regions strengthen. And what to watch for in November? Whether or not US AI mega rounds continue or start to slow, whether European deep tech momentum sustains, and whether Asia shows sign of recovery, particularly in India and Southeast Asia. An exit market continuation. Was Q3 an anomaly or was it a trend? The bottom line, the venture market is sorting into haves and have-nots faster than ever. But October showed us something important. It's not just about having capital, it's about having the right ecosystem. The UK isn't winning because it has more money than Silicon Valley. It's winning because it has diverse sectors, strong universities, reasonable valuations, and companies solving real problems. That is replicable. That is sustainable. And that's what venture should look like. I'm Aarish. This is Nothing Ventured. Until next time, stay liquid.